What's good, YouTube? It's Money Mayor here, and welcome back to my channel. And in today's video, as you can tell by the title, I'm going to be teaching you guys about market structure. This video is going to be called Market Structure 1.0, and I'm just going to be showing you guys the three main trends that the market moves in. And that is a bullish trend, meaning an uptrend, a bearish trend or a down trend, meaning prices gradually decreasing, and a consolidated market or consolidation trend, when prices just continuously fluctuate in between two zones of support and resistance. So to start, we have a bullish trend or a bullish market, and this is just simply when price is making higher highs and higher lows. Okay. So within a bullish market, these higher highs and higher lows look like this. You will see them looking like this. Higher lows, higher highs, and higher lows. At the bottom end, these are your higher low points, where price is using support areas to sit there and continue its overall uptrend. And on the top end, you have higher high points, where price is finding a resistance and bouncing its head off. Sellers are coming in for the retracement. A support is found, making a higher low point, and price is just continuing that trend. These trends are very important to know, and it is very important for you to sit there and know, okay, when you are supposed to be entering the market within these trends, so you can sit there and allow yourself to have the best risk to reward on these trades. And that is the main goal in this market, is to make sure that your risk is minimal and your reward is 10 times, So in a bullish market, you want to only be entering at higher lows. So if you notice you're in a bullish market and price is trending bullish, and you can clearly see that, and you want to sit there and take advantage of the move, you should only be entering at these higher low points. You should not be entering a buy order at some type of high. That is the simple buy low sell rule. Buy low sell high. And it's not even to say that you would sell high in a bullish trend. In a bullish trend, you're only looking for buys. You should not be placing no sells and no bullish trend, especially if you are an intermediate trader. Do not be trying to sit there and counter trend trade. It is not worth it. It's not worth your account. Just be patient and wait for the low to be made and buy at that low. Now, on the vice versa side, the next market that we trend within is a bearish market. And in this market, you will see lower low points. Let me just spell it out for y'all. Lower lows and lower highs. And this type of bearish market will simply look like this, where price is at a resistance, comes down, finds a support, you get a retracement down, or up, sorry. Price finds another resistance to bounce its head off, finds a new support, and the trend is continuing. You can see at times price will sit there and use previously broken supports as a resistance, bounce its head off of it, and use it as a resistance, bounce its head off of it, and continue moving down. These are called retests, and I trade like this. Like, this is my trading style right here. I trade off of retesters on the market with other confluences behind that, but they give you the best probabilities in my point of view, and it works for me, so maybe it'll work for you. But in a bearish market, on the upside you have your lower high points, and on the bottom end you have your lower low points. And in a bearish market, you only want to enter at lower high points. This is because enter at low high points. And this is just because simply the same thing. It'll allow you to sit there and have a better risk to reward on your trade entry. And yeah, it's just the same concept. Like in a bearish market, that buy low, sell high rule, you do not want to be taking no buys in no bearish market. Yes, it may make, like, you may see a support being found and be like, oh, okay, I'm gonna take a buy at this support. But you have to keep in mind you're overall bearish. So why are you trying to sit here and catch, you know, this small minor retrace right here? This is a little buy. Say you enter the market on a for a bullish move on an overall bearish move. You're sitting here trying to catch this move, which is only for 163 max pips, right? When you could really be sitting there trying to sell the market off once it reached this point and reach it for its overall TP or its new lower low, which is usually going to be 2 or 3 more times than this overall retracement. So it's just going to be better for you and your risk if you sit here and enter at lower high points on either bearish market or higher low points in either an overall bullish market. Now these two markets are very simple. They're very common. In the last market that you might come into, or market condition you might come into, is a consolidating market. And this is just when price is just being pulled and dragged upon these buyers and sellers, and no one is willing to sit there and give any type of let go on price. All right, and a consolidating market will look something like this, where say we're in an overall bearish trend and price comes down to a support area, finds a resistance here, but then buyers are like, hold on, I don't think we ready to sit here and continue and break the support. There's not enough sellers in the market to sit there and break that support. And price will sit there and just continue retesting these same areas until you get some type of breakout, where price will break past the support that it was testing for many times. Price will usually get a breakout, and your first entry will be at the retest of that support, turn resistance, and then you sit there and enter and sell off and enjoy your profit from there in this type of market. Consolidating markets require a lot of patience because you're literally just sitting here through all of this fluctuation, and it can get very intimidating and stressful. So that's why when you're entering this market, you're only entering once there's a breakout that occurs. And I mean, it's very it's not hard to identify when you're in a consolidated market, but it's hard to identify it early, because if price is here, you're just thinking, okay, this is overall lower high, I'm entering here, and price should go ahead and drop, right? But sometimes the market just doesn't have enough volume in it to sit there and break a certain support area or resistance area, and it'll sit there and consolidate. Now, luckily, these consolidation areas only happen within certain points within the market, like on your Fibonacci tool. There's a 23.6 area here, and more times than not, price will sit there and retrace and come to this 23.6 zone here, and this is where you'll see most of your consolidation at. And price might sit there and break out and go for a steeper retracement. Say it wants to sit there and retrace to the 61.8%, and price will sit there and continue its overall bearish trend to its TP levels. So I mean, it's not like you have to sit here and really be as mindful as a consolidation market, rather than you have to in the overall bullish and bearish market. But it's still important to know what to do when you are in a consolidation market, because you can still take advantage of the opportunities presented within these markets. But I just wanted to sit here and make y'all this quick video so you guys know what the 3 type of overall markets are. And yeah, this is just market structure 1.0. It's just very simple and basic, so you guys sit there and have a general understanding of overall market trends. But I will have a market structure 2.0 loading up soon, when we're actually on the charts and looking at actual candles and price, and help you guys identify that within the actual candlestick. So I hope you guys enjoyed this video. Leave a like if you learned something new. Subscribe for future content. And Money Mayor's out. I'll catch y'all.